Okay, so you want to run an insurance fraud scheme, not rob a bank, not deal drugs, just paperwork, a car, a doctor's signature, and patience. No masks, no getaways, no guns, just a fender bender that never quite happened the way the claim form says it did. You file the claim, you wait, and 30 days later, a check the size of a small salary lands in your mailbox. That is the pitch. And on paper, it looks almost boring, which is exactly why so many people fall for it. No neighbors calling the police, no die pack exploding in your face, just a slightly exaggerated story told to a company that, by law, has to at least pretend to believe you. It feels less like a crime and more like a negotiation, which is exactly the psychological trick that gets so many otherwise honest people to try it at least once. Here is the problem. It is not simple. The insurance industry loses an estimated $80 billion a year to fraud in the United States alone, and every single dollar of that is being hunted by someone whose entire job is catching you. The paradox at the center of this business is that the easier a claim is to file, the easier it is to flag, and the harder it is to fake convincingly, the more it costs you to fake it. By the end of this video, you will know exactly how the stage accident, the phantom patient, and the arson-for-profit scheme actually make their money, and exactly how the ledger closes when they get caught. Let's start with the easy part, because there is one, and it is the reason this crime attracts so many first-timers who would never dream of robbing a liquor store. The barrier to entry here is almost embarrassingly low. You do not need a weapon, a lockpick, or a getaway driver. You need three things: a plausible story, a cooperative witness or two, and a system that is legally required to trust you until proven otherwise. That last part is the real loophole, because insurance in most of the world runs on what is called the duty of good faith, meaning the company has to assume your claim is honest unless the evidence says otherwise. Staged auto accidents are the entry-level version of this business, and the oldest trick in the book is one investigators still call the swoop and squat. One car cuts sharply in front of another, brakes hard, and the driver behind has no time to stop. The at-fault driver, the passengers, and sometimes a fake witness on the sidewalk are all working together, and every single person in that first car can file their own personal injury claim from the same 10-second event. A single-stage fender bender with 4 passengers and 1 paid witness can generate 5 separate bodily injury claims from one afternoon of acting. Each claim can run anywhere from roughly $2,000 to $15,000 in medical billing and lost wage reimbursement, depending on how convincing the paperwork is. Multiply that by even a modest ring of 10 to 15 staged accidents a year, and you are looking at a business that can clear several $100,000 annually before anyone even notices the pattern. The entry cost for the organizer is almost nothing. A car that is often already scheduled for scrapping, a handful of willing participants, and a referral to what the industry calls a friendly clinic. That clinic is where the real money gets made, because the injury itself barely matters. The billing does. A soft tissue injury like whiplash is the fraud industry's favorite because it is nearly impossible to disprove with an X-ray or a scan. There is no broken bone to photograph, no visible bruise that a claims adjuster can point to and say this does not add up. So the patient shows up for weeks of physical therapy, chiropractic adjustment, and diagnostic imaging that a compliant clinic is more than happy to bill for, whether or not it was medically necessary. A friendly clinic can bill an insurer somewhere between $3,000 and $8,000 per patient for a standard course of soft tissue treatment, and because the clinic, not the patient, is the one submitting the itemized bill, the patient rarely even sees the actual dollar figure being charged in their name. This is where stage accidents evolve into something bigger, because once you have a friendly clinic, you no longer need a real car crash at all. You can simply invent the patient, invent the visit, and invent the injury. And this is where the industry's most expensive category begins: pure paper. Fraud, no accident required. Workers' compensation fraud runs on a similar logic, except the employer's insurance policy is the target instead of an auto policy. A worker claims a back injury that either never happened or happened somewhere else entirely, like a weekend softball game, and the clinic bills the employer's workers' comp carrier for months of treatment. Because these claims involve lost wages as well as medical costs, a single fraudulent workers' comp claim in the United States averages around $29,000, roughly triple the average legitimate one. Then there is arson-for-profit, the oldest form of property insurance fraud, where a struggling business owner burns down their own failing store, restaurant, or warehouse and collects a payout larger than the business was actually worth. The entry cost here is almost nothing but risk, a match, an accelerant, and a policy that was conveniently increased a few months before the fire. Insurers have gotten so used to this pattern that a policy increase followed by a fire within 90 days is now one of the single biggest automatic red flags in the entire industry. And then there is the most sophisticated tier of all, healthcare and Medicare billing fraud, where the fraud does not need a car, a fire, or even a real patient, just a billing code and a compliant provider. A durable medical equipment scheme can bill Medicare for wheelchairs, braces, and diabetic supplies that were never delivered to a single real patient using stolen or purchased patient identification numbers. This is the version of the crime with the highest entry cost because you typically need a licensed provider number, a shell clinic, and a network of recruiters paying kickbacks for patient identities. But it is also the version with by far the highest revenue ceiling. There is also a quieter, lower-tech version of all this called slip-and-fall fraud, where a claimant deliberately falls on a wet floor, an uneven curb, or a poorly lit staircase, sometimes at a store that has never even had a real accident on that spot before. The entire cost of entry for this version is a single afternoon and a willingness to fake a limp for a few weeks in front of the right people. It is popular precisely because it requires no accomplice, no vehicle, and no property of your own, just somebody else's floor and somebody else's insurance policy. Disability insurance fraud runs on a similar principle, but stretches out over years instead of weeks. A claimant reports an injury that prevents them from working, then quietly continues doing the exact job they claim they could no longer perform. These cases often collapse the moment an investigator does something almost comically simple, checks the claimant's social media for photos of them doing the very activity the claim says they cannot do. Every one of these entry-level schemes shares the same appeal. Low upfront cost, no obvious victim standing in front of you, and a payout that arrives from an anonymous institution rather than a person's wallet. That psychological distance is not an accident. It is the entire reason ordinary, otherwise law-abiding people talk themselves into doing this when they would never consider walking into a bank with a note. So that is the menu. Slip and fall and disability fraud at the very bottom, stage accidents just above that, workers' comp fraud in the middle, arson a notch above that, and healthcare billing fraud at the very top of the pyramid. None of these tiers run themselves, and almost every documented ring above the smallest scale relies on a role investigators simply call the recruiter, sometimes called a capper or a runner, whose entire job is finding warm bodies willing to be patients, passengers, or witnesses. A recruiter is typically paid a flat referral fee for every person they bring into the scheme, often somewhere between $200 and $1,000 per head, depending on the type of claim, paid out of the clinic's or organizer's share once the insurer's check clears. This referral fee structure is exactly why these rings can recruit dozens of participants without ever explaining the full scheme to any of them. Most passengers in a staged accident only ever meet the recruiter, never the clinic owner or the organizer taking the largest cut. It also means the recruiter is usually the second most exposed person in the entire operation, legally speaking, because their name appears, directly or indirectly, on every single claim the ring ever files. Now let's talk about why any of this actually gets paid, because an insurance company does not hand out hundreds of thousands of dollars because it feels generous. It pays because the entire system is built on a statistical bet, and fraud is priced into that bet from the very beginning. Every insurer sets its premiums using something called a loss ratio, the percentage of collected premiums that gets paid back out in claims, and a healthy loss ratio sits somewhere around 60 to 70%. Actuaries call this the fraud load factor, a small percentage built into every premium calculation specifically to cover the losses the company already expects to pay out to schemes it will never catch, meaning the industry is not surprised by fraud. It has simply priced its own blind spots in advance. A certain amount of fraud is already baked into that number, which means, in a strange way, every honest policyholder in the country is quietly subsidizing the fraud that gets past the system. The National Insurance Crime Bureau estimates that fraud adds roughly $400 to $700 a year to the average American household's insurance premiums. So the revenue mechanics of insurance fraud are simple in structure. The company has a legal obligation to pay legitimate claims quickly, and speed is the enemy of scrutiny. Most states require insurers to acknowledge a claim within roughly 15 days and either pay or deny it within a set window after that, often 30 to 45 days, or face financial penalties of their own. That regulatory pressure to move fast is exactly what a fraud ring is built to exploit, because most claims under a certain dollar threshold get what the industry calls fast-tracked, meaning a human adjuster barely looks at them before approval. This is why so much fraud is deliberately kept small. An injury claim of $4,000 draws far less attention than one for $40,000. So a smart ring runs volume instead of size. There is also a mechanism called subrogation, where after paying out a claim, the insurer can turn around and sue whichever party it believes was actually at fault, recovering some or all of the payout from that party's own insurer. This matters because it means a stage accident is never really settled once the first check clears. The insurer that paid out has years, often up to the state's statute of limitations for fraud, sometimes 6 years or more, to claw the money back if the fraud is later discovered. Claims adjusters themselves are not neutral bystanders either. Most are evaluated on a mix of speed and accuracy, meaning an adjuster who approves too slowly gets flagged internally just as fast as one who approves too many bad claims. That internal pressure is exactly why the fast tracking of small claims exists in the first place. It is not laziness. It is a deliberate cost-benefit calculation. Because manually investigating every $4,000 claim would cost the insurer more in labor than the fraud itself. But insurers are not defenseless. And this is where the paradox of the business really shows up, because every insurer of any size runs a Special Investigations Unit, or SIU, whose entire job is to find you. SIU teams use software that cross-references claim data against known fraud indicators. The same phone number appearing across multiple unrelated accident claims, the same clinic billing dozens of supposedly unrelated patients, the same witness appearing at 3 different crashes in 2 years. This kind of link analysis is exactly how large staged accident rings eventually collapse. Not because one claim looks suspicious, but because 100 claims all quietly pointed back to the same 12 people. Much of this cross-referencing runs through a shared industry database called ISO ClaimSearch, which pools claims data from thousands of insurers across the country, meaning a claim filed with one company can be silently compared against claims filed with dozens of competitors the fraudster has never even heard of. This is precisely why running the same trick across state lines or across multiple insurers used to be a reliable way to avoid detection, and precisely why it almost never works anymore. The industry stopped competing on fraud data decades ago because catching it benefits everyone equally. The Coalition Against Insurance Fraud puts the total cost of fraud across all lines of insurance at over $300 billion a year in the United States. Money that never touches a fraudster's pocket directly, but is extracted from everyone else instead. And every fraudulent claim that succeeds makes the algorithm slightly smarter, because insurers feed every confirmed fraud case back into the model, meaning the exact same trick works less and less well every single year it is used. This is the central tension of the entire industry. The easy money is only easy the first few times, and every single ring that has ever scaled up has eventually tripped one of these automated wires. There is also a newer enemy that did not exist for most of this industry's history, and it has quietly made the staged accident far harder to pull off than it was even 10 years ago. Modern vehicles increasingly carry event data recorders, essentially a black box similar to the ones in airplanes, logging speed, braking force, and steering input in the seconds before a collision. When a claimed low-speed fender bender's black box data shows braking patterns and impact forces inconsistent with the kind of whiplash injury being billed for, that mismatch alone is now enough to trigger a full SIU investigation before a single check is cut. Insurers have also started feeding claim photos through image recognition software that can detect whether a damaged photo has been digitally altered, reused from an older claim, or even reverse search to reveal it was pulled from a stock photo website. None of this makes the crime impossible, but it does something arguably more important to the economics of the business. It raises the cost of doing it convincingly, which is the entire mechanism by which fraud rates in mature markets tend to fall over time, even as the total number of claims filed keeps rising. On the legal side, most states classify insurance fraud on a sliding scale tied directly to dollar amount. A claim under roughly $1,000 is often a misdemeanor, while anything crossing a felony threshold, commonly somewhere between $2,000 and $10,000, depending on the state, exposes the defendant to state prison time rather than a county jail sentence and a fine. On top of prison time, most states allow courts to impose a fine of up to double the amount fraudulently claimed, plus mandatory restitution to the insurer for the full amount paid out, meaning the same dollar can legally be clawed back twice over before a sentence is even finished being served. One more structural fact before the case files, because it explains why this crime is never evenly distributed across the map. Fraud clusters geographically, concentrated in states with no-fault auto insurance laws, where a driver's own insurer must pay their medical bills regardless of who caused the crash, removing the natural friction of having to prove fault against a stranger. States like Florida, New York, and Michigan have historically ranked among the highest for staged accident and medical billing fraud precisely because their no-fault systems make it easiest to guarantee a payout the moment a claim is filed, with the least friction of proving anyone else was at fault. Every time a state has tightened its no-fault rules, added mandatory pre-suit demand letters, or lowered the threshold for what counts as fraud, the reported fraud rate in that state has measurably dropped within a few years, which is about as close to a controlled experiment as this industry ever gets. So let's look at 4 real, documented cases, because the theory only means something once you see how the ledger actually closes. Case 1. The Pacific Hospital of Long Beach spinal surgery kickback scheme, run by hospital owner Michael Drobot, one of the largest workers' compensation fraud cases in California history. The scheme ran for roughly 15 years before federal investigators unraveled it, aided by a whistleblower doctor who wore a wire during meetings where kickback payments were discussed openly. The scheme worked by paying kickbacks, roughly 15 to 20% of the billed amount, to doctors and chiropractors in exchange for referring patients for unnecessary spinal surgeries at Drobot's hospital. Because California law at the time allowed hospitals to bill outside insurers directly for spinal hardware, like screws and rods, at inflated, effectively self-reported prices, a single surgery's hardware could be billed at 10 times its wholesale cost. Over the course of the scheme, prosecutors say it generated roughly $500 million in fraudulent billing to workers' compensation insurers across the state. Drobot pleaded guilty in 2014 to paying more than $20 million in kickbacks and was ordered to pay $46 million in restitution and sentenced initially to 5 years in federal prison. Several of the doctors and chiropractors who took kickbacks in the scheme were prosecuted separately, many losing their medical licenses entirely, which means the referral network that made the whole scheme possible could never legally operate again once the case closed. The case also triggered a change in California law itself, closing the loophole that had allowed hospitals to self-report spinal hardware costs without independent verification, meaning the exact mechanism Drobot used no longer legally exists for anyone else to copy. If you divide his sentence into hours and set it against even a conservative estimate of what he personally pocketed before the case collapsed, his effective wage during the active years of the scheme was still enormous, but the moment restitution, legal fees, and prison time are subtracted, the multi-year return shrinks to something far closer to an ordinary executive salary, minus his freedom. Case 2. Philip Esformes, operator of a network of skilled nursing and assisted living facilities in Florida, convicted in what federal prosecutors called the largest single healthcare fraud case in United States Department of Justice history. Prosecutors alleged the scheme funneled patients, many of whom did not need the services billed, through a web of facilities and pharmacies, generating over $1 billion in fraudulent claims to Medicare and Medicaid over close to 2 decades. Court records describe patients being moved between facilities specifically to maximize billable days regardless of medical need, with kickbacks paid to doctors and hospital administrators to keep the pipeline of referrals flowing continuously. Esformes was convicted in 2019 on charges including conspiracy to commit healthcare fraud and money laundering, sentenced to 20 years in federal prison, though his sentence was later commuted in 2020, with restitution and forfeiture obligations in the tens of millions of dollars remaining in place. Even setting aside the commutation, the case is a useful lesson in scale, because $1 billion in fraudulent billing sounds like a business empire, but almost none of that figure ever became personal spendable wealth. Most of it moved straight through shell entities to pay recruiters, kickbacks, and operating costs before a dollar ever reached a personal account. As part of the case, federal prosecutors seized multiple properties, luxury vehicles, and financial accounts tied to Esformes, meaning a large share of whatever personal wealth the scheme did generate was converted back into government property years before the sentence was ever commuted. And because Medicare fraud convictions carry an automatic lifetime exclusion from ever billing Medicare or Medicaid again, the entire professional infrastructure that made the scheme possible in the first place was permanently dismantled the day the verdict was read. Case 3, a Southern California staged accident ring broken up by the State Department of Insurance, involving dozens of defendants who used the swoop and squat method across multiple counties over several years. Investigators say the ring generated roughly $25 million in fraudulent bodily injury and medical claims by recycling the same small group of drivers and passengers across dozens of staged collisions. The case only unraveled after SIU analysts noticed the same handful of cell phone numbers, the same tow truck company, and the same 3 clinics appearing across claims filed months apart in different cities, exactly the kind of pattern matching the industry's fraud algorithms are built to catch. Multiple participants pleaded guilty to insurance fraud and conspiracy charges, with organizers facing several years in state prison and restitution orders, while low-level participants, the actual passengers in the stage crashes, often received probation and a criminal record in exchange for payouts that, once divided among a dozen or more people per crash, rarely exceeded a few $1,000s each. That detail matters more than it sounds like it should, because the passengers, the people taking on the actual criminal risk, are almost always the lowest paid part of the entire operation. Investigators noted that several of the recruited passengers had participated in more than one stage crash without realizing how closely their names were now linked together in the insurer's shared fraud databases, a cross-company system that most participants did not even know existed. Once one crash in the ring was flagged, investigators were able to pull every other claim connected to the same participants, going back years, which is why these cases so often result in dozens of arrests at once, rather than one person at a time. Case 4, an arson-for-profit conviction involving a commercial property owner whose failing restaurant burned down within weeks of a policy increase, a pattern investigators call textbook. Fire investigators identified accelerant residue inconsistent with the owner's account of the fire's origin, and financial records showed the business had been losing money for over a year and had increased its coverage limit roughly 2 months before the fire. The owner was convicted of arson and insurance fraud, sentenced to several years in state prison, ordered to pay restitution to the insurer for the investigation costs, and permanently barred from holding an insurance policy of that type in the state without additional bonding requirements. The insurer, meanwhile, denied the claim entirely once the arson finding was confirmed, meaning the payout the owner had been counting on to cover the failing business never actually arrived. The entire crime was committed for a check that was canceled before it was ever cut. On top of the criminal sentence, the owner also faced a separate civil suit from the insurer seeking to recover the cost of the fire investigation itself, meaning the fraud did not just fail to pay, it actively generated a new bill. All four cases were built by state and federal investigators, piecing together patterns that took years to fully surface. No single tip broke any of them open. It was always accumulation, one flagged claim connected to another, then another, until the pattern was too obvious for a prosecutor to ignore. In every one of these four cases, the pattern is identical. The fraud generates a large gross number, the headlines report that gross number, and almost none of it survives contact with prosecution, restitution, and the ordinary cost of running the scheme in the first place. So let's open the invoice, because this is where every single one of these numbers gets its final honest accounting. Michael Drobot, roughly $500 million in fraudulent billing generated over the life of the scheme, but only $20 million of that ever moved as personal kickback payments. And of that, $46 million was ordered back in restitution, more than he personally received, meaning the scheme's organizer effectively paid the state to have run it. Spread across 5 years in federal prison, that leaves an effective post-penalty return best measured not in profit, but in years of freedom surrendered for a business that, on paper, never even broke, even once the courts were done with it. Philip Esformes, over $1 billion in fraudulent claims on paper, but a personal fortune built mostly on real estate and lifestyle spending that was substantially clawed back through forfeiture, on top of a 20-year sentence that, even after commutation, erased a decade of his life and left tens of millions in remaining financial obligations. If you divide his years of active operation by the portion of the $1 billion he actually kept as personal wealth after forfeiture, the real hourly wage of running the largest healthcare fraud case in American history was, once legal fees are subtracted, comparable to a mid-level corporate job, minus the 2 decades most people spend building a retirement instead of a legal defense. The Southern California staged accident organizers, $25 million generated across dozens of crashes and years of operation, but split among organizers, recruiters, clinics, and dozens of rotating passengers. The actual take-home for any single participant, before legal fees, rarely cleared low 6 figures, even for the ringleaders, and for the passengers doing the actual stage crashing, often a few $1,000s for a permanent criminal record. The real hourly wage for a passenger in a stage crash, once you count the hours spent coordinating, waiting, attending fake medical appointments, and sitting through depositions, frequently works out to less than minimum wage for a crime that carries a felony record attached to it for life. The arson-for-profit restaurant owner, an insurance payout that, after the policy limit, legal defense costs, restitution to the insurer, and years of lost income while incarcerated are subtracted, left the owner with a net financial position worse than if the restaurant had simply been allowed to fail on its own. And that is the invisible line item every one of these cases shares, the cost nobody puts on the original pitch. Legal fees that routinely run into 6 figures, even for a mid-sized fraud case, years spent unemployable with a fraud conviction on record, and in every documented case, the total collapse of whatever legitimate business or professional license the person held before the scheme began. Add up the 4 cases and the pattern holds without a single exception. Roughly $1.8 billion in combined fraudulent billing across all 4 schemes, against combined restitution, forfeiture, and fines that consumed the overwhelming majority of whatever was never already spent running the operation in the first place. There is also a line item that never shows up in any court record, but shows up in almost every one of these cases anyway. The cost of trust itself, because once a person is convicted of insurance fraud, every future policy they apply for, home, auto, health, carries a permanent asterisk, higher premiums, lower coverage limits, and in some cases outright denial of coverage for years afterward. And the ripple extends past the individual, every coworker, family member, or business partner who was pulled into the scheme as a passenger, a witness, or a patient now carries some version of that same asterisk, whether or not they personally profited from a single dollar of it. Insurance fraud is often called a victimless crime because no single insurer notices a $4,000 claim among millions. But the invoice for that belief always arrives eventually, and it arrives itemized with the defendant's name at the top and the state's name at the bottom.